Taxes. You might be wondering why you need to worry about taxes, other than filing your own individual tax return, of course. Well, as you know, companies pay taxes too, meaning someone has to worry about taxes. Great, you might now be wondering. But isn't that what tax professionals are for? I mean, I went into financial accounting so I didn't have to worry about taxes. Well, that's partially true. Tax professionals, whether those at a company or at an accounting firm, focus on matters related to a company's tax return and tax provision. However, income taxes also impact the financial statements. That means we, as financial accountants and auditors, also need to worry about taxes. In fact, there's an entire standard, IAS 12, devoted to the accounting for income taxes in the financial statements. IAS 12 applies to all entities in the accounting for income taxes. This includes domestic and foreign taxes that are based on taxable profits. The objective of IAS 12 is to prescribe the accounting treatment for income taxes, for which the principal issue is how to account for the current and future tax consequences of the future recovery or settlement of the carrying amount of assets or liabilities that are recognized in an entity's statement of financial position, and transactions and other events of the current period that are recognized in an entity's financial statements. Therefore, income tax is comprised of two components, current tax and deferred tax. Current tax refers to income taxes that are payable or recoverable in respect of the current period's taxable profit or loss. Said another way, this is the amount the entity owes the government for the current year. For the most part, this comes from the entity's tax return, which is rooted in the tax code. But IAS 12 does provide a few paragraphs of guidance on the accounting for current tax. In addition, IFRS 23, which focuses on uncertainty in income taxes, may also impact the recognition of current tax in the financial statements. Deferred tax refers to income taxes that are payable or recoverable in respect of future periods. But what exactly does this mean? It is inherent in the recognition of an asset or liability that an entity expects to recover or settle the carrying amount of that asset or liability. If it is probable that the recovery or settlement of the carrying amount will make future tax payments larger or smaller than they would be if the recovery were to have no tax consequences, then IAS 12 requires the entity to recognize a deferred tax liability or asset, with a few exceptions. Another way to look at this is that IFRS rules and tax rules are different, and the timing of recognition and recovery of assets and liabilities is often different, meaning that there are items that are recognized in the financial statements before they are recognized in the tax return, and vice versa. Since IFRS requires accrual basis accounting, the tax effect of these items must be considered, resulting in the recognition of deferred tax. IAS 12 provides a significant amount of guidance on the accounting for deferred tax assets and liabilities. IAS 12 also deals with the recognition of deferred tax assets arising from unused tax losses or tax credits, as well as the presentation and disclosure of income taxes. After discussing the scope, objectives, and basic principles of IAS 12, this course will focus primarily on the accounting for current tax. The IAS 12 Part 2 course focuses primarily on the accounting for deferred tax. Both courses discuss the presentation and disclosure requirements related to the areas covered in the respective courses. Let's get started.